Welcome everyone to this panel, the UNEP Global Roundtable 2020, the topic of which is North America Beyond Fossil Fuels, a Syndicated Transition. My name is Carl Pedersen. I am Chief Sustainability Officer for the Americas at Societe Generale, and I'll be moderating the panel today. And on behalf of both myself and the panelists, I want to thank you all for attending, and also thank you for to the UNEP for graciously hosting us on the panel. Just before I introduce our panelists, let me perhaps set the stage for a second with the notion that the subject of this panel, I think, raises two immediate questions. First, how different do we expect the North American experience to be around the energy transition and around the approach to fossil fuels? And this is a question that we encounter frequently. It's a question that stands naturally in contrast versus Europe, but also raises the question of how varied the experience is likely to be in North America, and can we actually speak of a North American experience per se? And secondly, in this context, how should we think of financial markets, both in terms of the role the markets play in allocating capital and in price discovery, but also in terms of systemic risk, right? And certainly this year, I think, has done nothing if not remind us of the systemic nature and the interrelated nature of all these risks and dislocations that we face. So to help us frame these questions and answer these questions, it gives me great pleasure to introduce our panelists. First, let me start with Commissioner Russ Benham, who is Commissioner of the Commodity Futures Trading Commission, the CFTC, which I'm sure you know is the U.S. government agency which regulates the derivatives markets, and I think it's fair to say aims to ensure market integrity and efficiency, right? And Commissioner Benham has been a sponsor of the CFTC's Market Risk Advisory Committee, whose publications just came out recently, and also been a strong advocate of responsible innovation in the derivatives market. So, Commissioner, welcome.
Thank you, Carl. Great to be here.
Our other speaker is Jonathan Hackett, who is a managing director and head of the Sustainable Finance BMO Financial Group. Jonathan's team raises capital, provides financing solutions, and offers advisory services for clients seeking sustainable outcomes. And Jonathan also has the distinction of a background in particle physics and quantum gravity, right? Which I think means he's probably figured out a few things about this reality that we haven't even begun to conceptualize. And finally, we also have Andre Bertolotti, who just jumped in, who is head of global sustainable research and data with BlackRock Sustainable Investing. And Andre leads efforts within BlackRock to develop the firm's ESG research capability, sustainable investment solutions, and also brings a deep quantitative research background, I think, that spans several continents. And BlackRock, of course, has been one of the most vocal advocates of ESG investing in North America and across the globe. So with that, welcome, gentlemen. It's a pleasure to share this virtual stage with you. And I also wanted to point out that while we are an all-male panel, I'm assured that the rest of the Global Roundtable is much more gender balanced, and the previous panel was all female, so I don't think we're skewing the equilibrium here in any way. So welcome to everybody, and look forward to the discussion. Let's perhaps jump in right now. And to set the stage a little bit, why don't we start with a narrative that I think we're all familiar with, which is that both in terms of policy and in terms of culture, North America does tend to gravitate towards the promise of market-based solutions, right? So the extent that we want to rely on financial markets, I think it does raise the questions of how we should even think of the link between climate change and financial markets. And we spend a lot of time talking about the way in which financial markets can facilitate the energy transition. But I think it goes the other way as well. There's an opposite force there, which is the need for systemic risk management, and by systemic, I think we can also lump in the financial system in there. So perhaps to start the conversation, Commissioner, if I start with you, and from the CFT standpoint as a regulator, how do you view the risk to financial markets tied to climate change and energy transition, and is there still a debate around this at the moment?
Thanks,
What do you?
yeah, thanks, Carl. That's a good question. And before I begin, thank you for moderating. Thanks, my co-panelists, for sharing the stage. It's an honor to be with them, and of course, thanks to UNEP FI for hosting this great event. It's great to be here during this important week talking about these issues. Before I sort of directly address the question, which is a good one about physical and transition risk, I think you mentioned at the beginning of your introduction that the CFTC, under the Market Risk Advisory Committee, which I oversee, issued a report managing climate risk in the U.S. financial system. The report came out last month in early September, and really I started the effort over a year ago, and in the absence of advanced work, I'd say, in the U.S. From a government perspective regarding climate change and the intersection of climate change and financial markets, both from a physical risk perspective and a transition risk perspective, I thought it was really important to put together a subcommittee of experts. So I got together a diverse group of experts from private market, academia, and NGO community, the environmental community, to talk about potential policy recommendations that the government could sort of consider in the sort of effort to address and mitigate climate risk, and use the input from the private sector and the NGO community to think about sustainable finance and climate risk. And the product is very comprehensive, and it's quite a document to sort of share, I think, and I would encourage your viewers to take a look at it if they could. And it really, in my mind, there's many things that I want to talk about, but a few sort of conclusions to point out. First, one conclusion is that climate change poses a major risk to the stability of the U.S. financial system and its ability to support the U.S. economy. There are a lot of opportunities, and this is something, the document is a risk document in many respects, and talks about disclosures and talks about scenario analysis and stress testing. It talks about better governance and the better collection and dissemination of data. But it really ties in, and I think this is important for our panel to talk about the opportunities that are out there from an economic perspective, and harnessing the power of the financial market and allocating capital in the right places so that the investor community and the regulatory community can come together and really lead the transition as best we can to a net zero economy in a smooth way. And the other conclusion I'll say before addressing the question is, huge element of the report was the focus on international harmonization. And I think we all know this, that climate change is not unique to any one country. Certainly from a U.S. perspective, it's not unique to any one geography or region of the country. We have to work together. We have to work in unison, and we have to think about climate risk and climate change together. Otherwise, we're really not going to be successful in addressing the risks that we face in the years and decades to come. From a physical risk perspective, and I'll break down your question from physical and transition. From a physical risk perspective, and you alluded to this, unfortunately, from a U.S. perspective, again, stark reality of what we've been going through for the past few weeks and months has really demonstrated what physical risks we're facing from climate change. And obviously, speaking about the wildfires out west in California, Oregon, and Washington, devastating to communities, devastating to the entire region. And you could see how this would obviously have a direct effect on economic growth and creating what the report calls almost a subsystemic shock, a regional shock to the economy, to the communities in those areas. And I obviously want to mention the hurricane season that we're seeing in the Gulf Coast as well. You think about these events as they're happening, they're growing in frequency, they're growing in sort of their extreme nature, and we have to be cognizant of what this means for regional economies and then the entire country as a whole, and how that plays into financial systems and the financial markets, whether the resiliency of the financial market, the ability of the financial markets to continue to provide credit and liquidity where it needs to be, And then from a sort of human health perspective, the ability of individuals and communities to sustain life in different areas and regions of the country, and what that means if we have these migratory patterns. From a transition risk standpoint, the report was very sort of front about what it views as transition risks as we sort of transition to a net zero economy. And the one conclusion I'll mention is we have to deal with the transition to net zero and to renewables, and what that means for the sort of core of the economic foundations that we rely on and have relied on for a number of years and decades. But the reality is the risks of climate change in the future are far greater than the transition risks that we're going to face in the short and medium term. So that should not be sort of a signal that we have to hesitate or overthink what we need to do in terms of our larger goal of transitioning to a net zero economy. I've had a lot of conversations with folks in DC, elected officials and other policymakers. Transition risk is sort of a top of mind issue because of the potential devastation that it could manifest from an economic standpoint. And you can imagine from you think about the international harmonization front, the comparable and competitive disadvantages that one country might face if, there's a first mover versus other countries. These are real and serious questions, and we have to think about them. But it really, I think, in my mind, ties together the importance of harmonization, working with our partners overseas, and understanding that the risks of climate change in the future are far greater than the transition risk that we're going to face in the short and medium term as we move to a net zero economy and focus more on renewables and away from fossil fuels.
Thank you, Russ, and I think you raised the right points, right, of the difference between physical risk, transition risk, different horizons, all these different bits and pieces. Andre, perhaps building on this, and with BlackRock has certainly taken a bit of a leadership voice in the investor community and globally around the call to arms on everything ESG. From a more of an investor standpoint, do you echo Commissioner Benham's views, and why or why not? Any differences you see?
Absolutely, and thank you for inviting me to the panel, and thank you, Commissioner Benham, for that very comprehensive introduction. I'll build off of that and bring in the focus, as you mentioned, Carl, of the investor. And certainly, we have spoken about the need to be a long-term investor, and that requires a focus on sustainability. So in the view of a long-term investors, we need to look and consider the geographical differences that the commissioner spoke about. We also need to consider the timeframes, what is happening now, and then what is likely to happen in the next couple of decades. And for this, we're looking at megatrends. So these are non-reversible changes. It's not like we're going in that sort of economic discourse of cyclicality. Now we're in a recession now, we're going to get out of it, we're going to go back into it. This is a trend, it's a shift. So we have to think about that framework where history is not going to be a great predictor or a great help for us as we go forward. As the commissioner mentioned, even in the physical climate risk, we understand now the events are becoming more frequent, more intense, lasting longer periods of time. So we're not going to be good students of history to understand what's going to be happening in the future. So, what can we do as investors to link this? Well, one of the things we're trying to do is understand more about what companies are doing. And we are asking companies to be more transparent and to have greater amounts of disclosure. There's a long history about financial and economic disclosure that's well regulated and well structured. And we're now entering the area where we need additional sets of disclosures that are going to help us understand these new risks that companies are facing. So we are promoters and backers of the efforts by the SASB and by the TCFD to help harmonize that trend. Regulators are going to play a big role. I love the term harmonizing, and I think in terms of creating a level playing field across regions, across jurisdictions, in terms of sort of keeping our eye on the ball, what it is we're trying to achieve, which is sort of a transition, an orderly transition, but also not creating packets of advantages and disadvantages that can be leveraged and arbitraged. The exciting part, I mean, we are in a phase of change, so that's going to create risk. That's going to mitigate it with more information, more transparency, and more clarity. But it's also going to create opportunity. There is a lot of front-footed thinking in the world of companies, regulators. Certainly, we're seeing academia step into the fray in providing sort of information and frameworks that we can use to help us cope with these changes. Um, I know we're focused a lot on public markets also, but there's a big role to be played also by private markets, private equity, private debt, infrastructure investing, all of those types of components that maybe not fall directly under a regulation, but are going to be a big component. I'll turn it over to you, Carl. You're on mute. Carl, you're on mute.
Can you hear me now? Yes. Sorry, when we move over to the more the banker's perspective, right, which is what I do and what Jonathan does, Andre, you were talking about the need to ask companies to do a lot, and there's what we talk a lot about. There's a specific language that needs to be harmonized, but there's an underlying conversation as well at the company level that really needs to take place. And I guess, Jonathan, of all these comments that we've spoken about so far, to what extent does your experience intersect with that, from a banking standpoint, but also candidly from a Canadian bank standpoint, right?
Yeah, I think one of the biggest things we talk about, market-based solutions, is that regulation and investment are in some ways the core pillars of how those are driven. If there aren't financial mechanisms that bring externalities into how business is planned for the future and how a business case is created, then there's no means by which a market solution can happen. So I always think about, my job as, how do I help companies access capital? How do I help them access revenue? How do I help them create the tools that allow them to add sustainability to what they do? So if we look at what's happening in the US, and something that I feel like I'm constantly talking about with Canadian market participants as an example, 45Q is a regulation that creates, without saying there's a price on carbon, creates a price on carbon in the sense of this is a way of gathering capital, a way of actually attracting capital without, I think, bringing in a near-term hit on all those other industries and creating the near-term transition risk. And so that's the kind of regulation that when we think about our clients and how you can help bring new solutions into the market, it's something that's a market-based approach, but without, creating the exposure on the other side. And in some ways, it's a stimulus because of it. And in the same way, from an investor perspective, as from a government perspective, there's almost a free rider problem, where we talk about, Andre, the work your team is doing, the work that BlackRock's doing, the work that other ESG integrated investors are doing, as beginning to shift the perspective of where capital is, and the access to capital for people that are aligned against a long-term sustainability point of view. But there's a reality underneath that in the near term, if you say what's the ESG impact for the next 2 months, those are very different questions than the ESG impacts going out of the next decade. And the ability to create a differential cost of capital for companies that are performing well, that rewards people for making those investments, is hard, because until more investors are either acting as a catalyst or there are other kind of mechanisms driving those market forces, we always think about how do you create the reward for the people that are doing that. And that's where the work that we've done around sustainability-linked loans, the kind of recent efforts around sustainability-linked bonds, all of these are tools by which people are trying to either align time horizons, align other incentives to create benefits, but really trying to bring those elements from the market. And that's where I do see a strong commonality between Canada and the US, where I feel like those things are moving at similar paces. And as well, that I think a lot is being led within the bank market, where we see what we're doing with our clients, both in Canada and the US, as driving in faster than often the access to the debt capital markets.
Great. Thanks, Jonathan. To move the conversation forward, I think one of the themes that's coming out of this is the fact that there, if we think of it again as this broad sense of systemic risk and things like that, trying to pinpoint exactly what it is we need to look at and what are the things that work things like that is a particularly difficult exercise. And I think partly because I think, transition implies tension somewhere, right? So it's tension between growing energy needs and lower carbon. It's tension between public and private roles in innovation and things like that, between, remediation and innovation, all these kinds of things. And again, to the extent that we're focused a little bit more on a market construct here, it does require a need for experimentation. It requires, a wide and complex mosaic of solutions that would work, and certainly some successes, some dead ends, and things like that. And it requires funding for all of this also. So maybe using that as a jumping off point to move the conversation forward. If I turn it back to Andre a lot, I think there's a very strong argument to say that the funding will need to come from institutional investors. Just when you look at where the wealth is in the world today, at this point, from your perspective, given this entire range of possibilities and all these moving parts, is there a preferred approach in terms of technology, in terms of scientific preference, one or the other, into which capital would tend to be allocated? And does that already suggest some sort of glide path from your perspective? Is there already a direction that we can see?
Yeah, very interesting question, and it has some sort of important implications. If I can sort of start with the term funding, because I like to sort of clarify a little bit around that term. I think funding, can have implications of grants or financial assistance. And I think in that area, our governments have a very big role to play. We're talking about sort of the green recovery, how we're allocating capital now that we're coming out of the green, or possibly into a green economy after the COVID pandemic. But if I can make a point, this is a lot different than how we, as an asset manager, view it. We have a fiduciary responsibility to our clients. So what we do is we allocate their capital into promising areas of investing that provide a reward for taking on a risk. So that is certainly a role where we as an asset manager have a lot we can do, like you mentioned, both in the private and in the public markets. What we're doing is really seeking out investments, companies in this case, that are thinking about their business strategy, they're thinking about their stakeholders, they're thinking about sort of their positioning vis-a-vis their peers, and they're leaning into changes that we think are inevitable and coming. And those companies to us have already embedded a concept of sustainability in their plans and become a more attractive investment than companies who are not taking those steps. So then when we allocate to those companies, we're really leaning into what we think is a promising area of investing. So that is sort of how I see this difference between the funding and the allocation. What's also really interesting is that we think about it in terms of a global economy, and trying to understand the differences, roughly speaking, between the developing world and the emerging markets, and the need for capital and sort of the application of public funding in those two scenarios. Thinking about the developing market is where most of the global investments are located, but it's also the area where most of the resources are available to address climate change and climate risk. When we look more at the emerging markets and emerging economies, maybe these are based more on climate sensitive economies, agriculture, commodities like fossil fuels. And these are locations that are already financially challenged and stressed, so their ability to recover is going to be less. So how we think about those markets is going to have to be different than how we think about the developed markets in terms of allocation, and also encouraging government and public funding, or at least maybe public-private partnerships in those areas to help bring more investing into those parts of the world. And finally, there is a role that we can play through our stewardship and our engagements. We can certainly ask companies what they're doing, how they're dealing with their challenges and their views of transition, and sort of encouraging them to consider those particular components in their strategy, because that's important to us as long-term investors. And we ask a lot of questions, but then we make two requests of all the companies. Please disclose and please be transparent. And with that, we think we're better armed to understand those tensions, Carl, that you're talking about.
Great, thank you, Andre. Jonathan, I'll pass it on to you as well for a couple of minutes on, as we look at these different paths. And Andre was talking about the different possibilities between, say, public and private and things like that. And Russ, that's a question I'll ask you in a second as well. But Jonathan, again, looking at the kind of individual company level and asset level and the financing level from a banking perspective, certainly transition suggests there's different kinds of transitions within the broader energy transition, right? And do you have a view on what the right path is right now in terms of, saying, technology, right? Where we can talk about natural gas, we can talk about hydrogen, we talk about electrification, all these things right now, but is there, do you sense there's a consensus on all that at the moment in this part of the world?
So I think the answer always to that kind of question is no. I don't think there is. Anytime you say, do you think there's consensus, often, it's hard not to give that answer. But I think, let me address that in two ways. So one is just, there are big unknowns. We are 30 years out from 2050, and some of those fundamental choices that you need to make as a society about what a net zero future looks like just haven't been made. So the easiest example is net means the sum of positives and negatives, and often that's not how it's interpreted. People very much will think about things that are inherently net zero versus things that achieve net zero through offsets. And our willingness and our desire to have large scale carbon sequestration, large scale offsetting activities in order to maintain what might be a very hard to reduce core of carbon emissions that owe to either legacy infrastructure or to other pieces just haven't been made. And that appetite actually will define a large amount of capital allocation that needs to happen for the next few decades. So things like, are you shifting entirely to hydrogen versus is there a world of net zero natural gas that needs to sit alongside it? Are we electrifying everything? And therefore, here in Canada, where my stove currently would have to be replaced, my furnace, my clothes dryer, all of those things that rely on natural gas, that's a pretty material choice that somebody is going to have to make. Or if it doesn't happen, it is not made explicitly, it will be made for us by a series of successive business cases. And the reality that asking every individual to bear the cost of removing the last mile or replacing the last mile of that delivery is actually just never going to happen without a large-scale natural choice. So I think yes, there's no consensus. I think there's a lot of opportunities for those different industries to position themselves as a natural leader. The near-term cost positioning is going to do a lot of how people are privileged or not as they set themselves up to become a default choice. In some ways, that's unfortunate because often, even within ESG, people view assets on performance today versus what's improvable. I think that's a huge opportunity, especially when you talk about environmental impact, to look at what assets are operating at peak performance today, but still not as good as other assets can get to. I'm not good at baseball, so I won't make the baseball analogy of a trained hitter hitting that 400 versus a wild hitter hitting that 400, and which one you want. You want the one you can improve. But all of that is on the how do we figure out the right technologies for the future side. I think on the other side of it, around at the company level, transition is one where we talk very often about the and at BMO. So that we want to look at both the technology companies that are creating solutions and how we can help all of our clients navigate that transition. And I think that the needs of large-scale emitters today, of which are most corporates in industrial sectors, to have access to funding that is privileged towards the investments that they need to make, whether it be via a labeled product or just via a recognition of the capital markets that things that look off strategy are not off strategy if they're setting you up for long-term risk management and for long-term access to capital and long-term access to the market. And so how do we help those companies, whether it's installing new machinery that's electrified, whether it's replacing some of their power generation, whether it's offsetting activities, how do we help those companies make those investments is one where I think the market needs to catch up to the need, and we need to create more solutions.
Right. Right. And I want to get on that final point you just made on the market needs to catch up, so to speak. Um, Question to you, Commissioner. Um, a lot of it has to do with market incentives, right? In terms of managing all these tensions, and certainly when we look at the need to decarbonize, this is not, the stakes are very high, and it's a very steep slope that we need to face, right? That we need to embrace. When you look at market structure, do we have the right incentives today? Are we close to having the right incentives? Do we have incentives that lead to more carbon and not less carbon? What do we need to do? Where does that come from?
So, and it's a good question, Carl, because your first question, or at least your intro, you talked about how the U.S. is largely a market-based economy. We have been for years, and I would say pretty clearly, by and large, it works, and it has worked. But climate change and the issues that we're facing today with respect to energy production, carbon emissions, and trying to figure out ways to get to a net zero, as Jonathan pointed out, are difficult. And I don't think, and I often say this in the context of, I think if you look at the literature about climate change in earnest, it dates back probably about 40 or so years to the, I think, mid 80s, when scientists were first starting to make observations about unusual environmental changes outside the scope of what history and records had demonstrated over the course of decades. And, up until now, in many respects, notwithstanding some incentives in the tax code and other sort of investment programs from a public sector standpoint, a lot of the transition has been market generated. And I think if you look at the scientists, and I'm not a scientist, but if you look at the available science, the science that is most readily used, we're not where we need to be, and we need to move quicker, and we need to have more of a cohesive strategy to get to net zero and to reduce our carbon emissions. So with that all said, I don't think the market incentives are working. I think we need to do more to create better market incentives so that capital can be allocated in better places and in the right places so that we can reduce our carbon emissions. At the onset, and the very first thing I'll sort of point to is within the context of the CFTC report, the first recommendation of 53 recommendations is putting a price on carbon. That is the one recommendation of the 53 that falls outside the scope of a traditional financial regulator, and one that requires congressional action as opposed to something that can get done by a regulatory body. And when you have 34, institutions and individuals and members of sort of the economy saying this is the number one recommendation we need to make to the government, is that you need to put a price on carbon because incentives are not aligned, I think that's sending a pretty clear and stark message. And I would point to, there was a report from the G30, which is co-chaired by Governor Carney and former Fed Chair Yellen, that was released last week. And again, a number one priority for that set of recommendations was a price on carbon. So at the outset, I think if we get the price on carbon, and again, Jonathan spoke to that, it's a negative externality right now. No one owns the atmosphere, and no one's really going to truly work around the damage that carbon is sort of putting on the atmosphere unless we have a price on it so that businesses can sort of manage their short and long-term financial horizons around that. And I think that would be obviously a huge start and something that the international community has to work on together in order to implement, but something that I think is key in order to accelerate the transition and in my mind, make it smoother so that we understand where capital will be going, I think, with a clear lens and understanding that we have to shift away. The other incentives, which I can talk about, come within certainly fiscal policy, the tax code, and other programs that you mentioned from a public-private standpoint, whether it's an investment program between the government and private sector, co-investment programs, economic stimulus, which Andre pointed this out, as we're emerging from COVID. There's so many discussions going on globally about how we think about the 21st century economy, right? And how do we make it sustainable? How do we make it more green? And I think there's a lot of opportunities for infrastructure spending from a, certainly a U.S. perspective, but other global economies as well, to start to implement better incentives for private sector actors to take action that is more aligned with sustainable practices.
Thank you for that, Commissioner. I think, but I want to build on some of these points, and I'm also aware that we could probably spend a few hours talking about pulling on any single one of these threads, right? But I wanted to build on one comment you had, which is this notion that, yes, it's a market-based economy, and look, there's a realization that the market, by and large, has done some good, right? Has done a lot of good, right, in the world. Also, I think the entire point of sustainability is that it doesn't address a lot of the issues we have, right? Or it doesn't necessarily predict a lot of the issues we have. And I want to go back to the notion of things being systemic here a little bit, which I think is what we're all pointing to here. In this notion that we can't look at climate change in isolation, right, as just one topic that needs to be solved. And I think we're already seeing a lot of the environmental issues quickly turning into social issues, right, in a big way, and certainly exasperating a lot of the social dislocation that we're seeing. On one coast we have millions of acres burning, and then we have kind of endless hurricane formation on the other coast. Right, these are things that affect people in the physical world, and so it's not hard to imagine a scenario where the environmental piece of it causes the social part of it to get worse quickly, right? Either from direct or discrete events, or just from wider systemic shocks and things like that. And so this opens a question for, in a broader sense, we're looking at an energy transition that also needs to be a just transition, right? And that needs to have that broader sense of sustainability around it. And I want to get back to you on back to your point, Commissioner, and what you were saying about incentives and keep building on that. I guess at this point, does all this narrative suggest a specific role for government, for regulators? I know we've been kind of going a little bit in that direction, but at the intersection of climate change, of incentives, of innovation, social dislocation, and in your view, are there lessons to be learned from other parts of the world, or vice versa, in how this is done?
Good question, and there's a lot of parts to it. I want to start with your suggestion about, or at least the way I heard it, about disproportionate impacts of climate change, and then a possible redress of climate change issues and how those are going to be impacting different parts of society. Again, pointing to the CFTC report, a huge finding, and something that really is woven into the entire context of the report, which again, as I said, is very comprehensive, is that climate change does have a disproportionate impact on low to moderate income communities and families, specifically within the U.S., but you can certainly see from data across the globe how that is also very true. So as we think about addressing climate change and mitigating those risks through, again, a net zero transition, whatever policies we take, I think both from the private sector and public sector have to be cognizant of those issues, because that transition and that movement, obviously, to address a very serious and in reality a potentially existential threat, could have larger consequences, or at least additional consequences that we don't want to make worse. And I think that in many respects is your point. And I think from a policy perspective, speaking from my shoes, I think any policy or any role that the government can play and should play in the climate discussion has to keep that very stark reality in mind about low-lying areas near the sea level, obviously rural communities, you name it, about how climate change has disproportionately affected certain classes of people, both from a socioeconomic standpoint and how we need to address those problems going forward. In my view, climate change is a problem of the commons. We have to address this collectively, and in many respects, as we're living through a pandemic, I unfortunately think that the reality of what we're going through today is and should be a lesson for the climate crisis that we're sort of living through today to an extent, but we're only going to be dealing with in many more ways in the years ahead, and how important it is to have a public sector role in this conversation for many reasons. Obviously, the incentives and the power that the government has from a very basic level of creating and working with international partners to set a carbon price and create incentives there. I obviously mentioned the infrastructure program and the infrastructure spending that can help in using the sort of power of the government to sort of allocate capital and work with private sector actors. On a very practical level, from a sustainability standpoint, and Andre can speak to this, but we talk about ESG investing and what does the investor know about ESG criteria? And there's been amazing work at the TCFD level to sort of set a standard of what definitions and taxonomy and language that we need to use so that it's consistent, it's comparable, it's reliable, and that's fantastic. But I also think at this point, given that momentum from the private sector standpoint, you really need the official sector to step in and sort of mandate a lot of those disclosures so that we're really seeing the change in an efficient and effective way going forward. We have to have global convergence of these policies and these ideas. If we're not going to work together, both from a public standpoint and a private standpoint, it's just not going to work in my mind. And I'll end with this. And again, another finding very clear from the report, and something that I try to mention as frequently as possible, is yes, there has to be a role for the government in this conversation. Yes, there can be a positive role to move the transition in a smooth way and to incentivize private actors to allocate capital in better places. But whatever action is taken by the government, it has to be flexible. It has to be iterative. We have to work and understand that climate change is not a linear problem, and the risks and what we face in terms of future risks from climate change and the predictability of climate change is not linear. So we shouldn't be too prescriptive. And this goes, I think, to the final parts of your question, is what we can learn and shouldn't learn, or what lessons should we take away from actions of other countries or other regions. Is, there are a lot of things we can learn about taxonomies and disclosures and stress testing and governance, obviously. But we have to remain flexible. We shouldn't be too prescriptive because things are not linear, and we have to be able to adapt as the climate crisis faces us and presents new challenges almost on a daily basis. So that's a hard thing to do, I think, for the government in many respects. It almost is counterintuitive to what many people might think the government does and how it acts. But I have a lot of faith, and I know that people care about this issue deeply. I think the CFTC report is a demonstration that folks in the U.S. care about this deeply, and we just have to be active and on our toes, and understanding that in order to do this effectively together, we have to be willing to adapt as the climate adapts itself.
Great. Thank you, Russ. Maybe let me turn it to Andre really quick. I think that's a very natural segue where Russ was talking about the need for both conviction and fluidity, I think, a little bit, right, in this approach. And very much to the points you were making, I think it's tempting to speak of the market as a bit of a monolithic construct, right? But marketplace is just the result of many actors and policies. And so, again, in your observations as a global firm and deep of what market participants do, we talked about the role of government, we talked about the role of banks, but what about other actors, whether it's accountants or venture capitalists, rating agencies, cash-rich corporates, or the SEC, it's kind of sister organization to the CFTC. Are there any observations that lead you to have specific opinions on that, Andre?
Absolutely. So a lot to unpack here. Um, but sort of building up on that topic that Commissioner Benham mentioned about this sort of E and S components sort of coming together. Um, what we're seeing is sort of like the convergence of three events. So we were seeing climate change. We talked about the fires in California, the hurricanes, fires in Australia earlier this year. On top of that, now we've entered this era of a pandemic and a pandemic-induced recession. Uh, Very, very impactful. And within that, we're also seeing developments in the US, particularly racial unrest, very high unemployment. And, at some level, it's possible to see all of this being part of one overall theme about transition and about change and about our ability to adapt. And our CEO in June issued a letter sort of challenging corporations, including us, BlackRock, to do more. So I think corporations can and will step in within their bounds to look at their internal employees, their supply chains, and sort of be leaders in that area to bring about sort of a convergence and an improvement, certainly in that S from a corporate. But I also think that we sort of collectively, people in general, are going to have three levers. I mean, we are consumers, and we have choices and we options. And we've seen earlier, for example, a big uptick in consumers looking for ESG type of investing as opposed to core investing. Um, we also have a role as employees, and we look at our companies and we talk about diversity and inclusion and equity and sort of come up into that conversation internally. So there's the S component coming to life. And finally, and timely, we're voters. And so around the world, wherever votes in a democracy can make a difference, we will have that lever as well to bring about change. There is this growing focus on S, but that is not coming at the cost of E. So I think there are a lot of commitments in place for the environmental side. We're seeing the EU taxonomy coming out, helping investors and asset managers alike think about integrating the right type of product in their offering. Green bonds are just going one after the other. We're reaching about 2 trillion in issuance in green bonds. So there is an appetite, out there to finance this change. The International Business Council is also putting out guidance, and we've seen earlier in the month 4 big accounting firms coming around a common sort of framework for helping their clients disclose on climate change. And these are sort of the things that we need to become more and more accustomed to. It's not a trade-off, more E, less S, or more S and less E. It's just all going to be more. It's going to be more central and more important.
Yes, I hear you. And Jonathan, I'll give you 3 minutes because we're getting towards the end of the session as well. But we have some questions coming in during this panel too, around how can we, in a sense, how can we make sure this has an impact, right? And the right kind of impact, and back to the sense of a bit of a just transition, right? When we look at companies, I think it's easy for people to approach this as a bit of almost a tick the box or a compliance exercise. But I think one of the things that we've discussed is that it goes to very, very fundamental issues, right? And this kind of license to operate and things like that. So again, from your experience, Is there the right level of consciousness for that? How does that tend to intersect with all this?
Yeah, I think I often have conversations with corporates that say, well, is S really that important? So many questions come in about E, and S. We don't really think about our community involvement that much, and it's often, to me, ironic because the corporations are saying that are the ones that are most often, at the tail end of 20 years of having focused so heavily on the key factors that drive S that they don't even realize anymore how much it's ingrained into their culture. Whether it's anti-bribery and corruption, whether it's worker safety, whether it's being a natural resources company and having to comply with the equator principles as you engage with different stakeholders in the community. All of that work is what gives those companies license to operate. And the Callus statement is forget about it for a minute and see what happens to your company, right? So if you forget about worker safety for just a minute, if you allow things to grow unchecked on your operations and how you operate in the community, you will very quickly find the value of your company disappear. And so I think we often focus on the leading edge or some future indicator, and social justice is a big thing that a lot of companies are thinking about, and it's a very important issue as we continue to think about continued license to operate. What does it mean to be a purpose-driven company, to be a community member as well as a corporate? But I want to make sure that companies and individuals don't forget about all of that work that kind of sits just below the surface, that we're not so far away from, and many companies still today, depending on where you are in the world, operate with those as key, license to operate or license to exist questions. And I want to also just quickly tie back to this concept around transition, just transition, and why I think it's so important that we don't forget that that's a tool for corporates that exist today, and that, yes, I think it's great to focus on what new companies can come after or could bring in new solutions, but often we forget that all of the markets are predicated on risk. And for all that we talk about climate risk, for all that we talk about all these other kinds of risk, the idea that, a bank is going to issue $2 billion in infrastructure funding to a company that's existed for 2 years, has no track record, and is, just getting, out there, isn't how the world is ever going to work. We just can't take that kind of risk. Whereas if we can incentivize existing corporates to go down that path of the transition, to do it in a just way, and in exchange, have them be off-takers, have them be the purchasers from those new companies, you can finance that all day long. You can, pile debt in if you're able to demonstrate that all these companies that exist today need this new kind of company in order for them to continue to exist. Then you know that there's always a market. And so for all that, I think it's easy to sometimes say, well, there's the old economy, there's the new economy, let's just focus on the new economy. Creating the tools for the old economy to adjust, to transition, to do that in a way that doesn't involve massive dislocation of workers will give us way more tools to address this faster and more effectively.
Yeah. Thank you, Jonathan. As I'm seeing the questions that are coming in through our panel, I think a lot of it has to do with, what's standing in the way of things moving faster? Why can't we transition faster? What are the incentives and all that? And I think it's very much what you were alluding to, that there's again, what we were saying earlier, there's this natural tension, right? That all these different pieces need to work. And I think in many ways, if we couch things in terms of externalities, as a marketplace, as a society, as various actors, we're not accustomed to capturing and resolving all these externalities, right? So this entire new language needs to be able to function, and these different actors need to be able to talk to each other in order for the machine to work, right? And that's part of the effort that we're trying to move forward while still creating a little bit of this language. We have 5 minutes left, and I'm trying to broadly address the questions that are coming through as well. Perhaps if I can turn it back to each of you for 1 minute each for a final quick statement on what you think we need to do as North America moving forward. What's the biggest thing that you really want to see happen? And we're all passionate about this, and where are you zeroing in your passion in this thing? So maybe Commissioner for a final word. You're muted. Can't hear you. Can't hear you, Russ. Maybe we'll switch to Andre and let you figure it out.
Russ, I'm sorry. I don't want to take your thunder out of this initial comment. So let me just focus from the point of view of investing. I think it's a very exciting period. I think change offers the prospect of managing risk, but are also of looking at opportunity. And to Jonathan's point, it's not a niche or a boutique solution that we're after. It's a holistic a solution that it's going to cut across public and private markets and also across asset classes, equities, bonds, commodities, the whole gamut, infrastructure. And the challenge is very big. But if I can just point to another sort of actor that we haven't addressed, I think asset owners globally have stepped in
Yes.
and they have stepped up. And there is a lot of leadership coming from that group of investors. And that is something that certainly BlackRock and other asset managers are aligned with and are listening very close to. So, that's independent of regulation, but it's very aligned with the goals that also governments are seeking. So it's yet another component and wind on the back of this transition.
Thank you, Andre. Russ, back to you. I think your microphone was working.
Can you hear me now?
Yes.
Great. I would say from again my shoes, what I was really heartened by in my efforts to talk about climate change and climate risk within the context of the MRAC report and what we came out with was 34 individual members and institutions coming together, reaching consensus, and voting unanimously to support both the conclusions about climate change and the policy recommendations. And my final note, and I speak obviously to all of you are here and the institutions that you work for are here because you care about these issues, and that's fantastic, and you're the leaders in the space. But I would certainly encourage others to step up, to speak up, to be a part of the conversation. There is, to use this word we've used a lot in the past hour, a political friction about climate change, a changing climate, what needs to get done, what are the repercussions, what are the unintended consequences of all this? How do we do it collectively? My goal in putting the committee together, bringing together diverse constituents and stakeholders from energy, from agriculture, to investors, to banks, to NGOs, you name it, was let's get the broadest, widest, diverse coalition to raise awareness so that we can tackle and break through that political friction, because we have to move quickly. We have to move decisively. And if we have this political friction continuing to slow us down, there's going to be long-term negative consequences that we're going to all regret. So again, to the community, I think here in the U.S., this report should demonstrate a lot of what the U.S. thinks, and we want to work together. We want to engage with the stakeholders, all of you, BMO, BlackRock, SocGen, and others. And if we do this together, I think the outcomes will be very positive.
Thank you, Commissioner. Jonathan, final words?
I'm actually going to give it back to you, Carl. I know we've run in, so if you want to say anything final before we get cut off, please.
No, well, thanks for that. Just to thank each and every one of you, right, for your thoughts, for your opinions, for your valuable comments. I think it's fair to say that this is going to take us in unexpected directions, right? And so the kind of mix of fluidity and conviction that we were talking about earlier, I think is going to be critical. There's a lot to balance, whether it's public and private, whether it's again, the tensions in growth versus curtailment of different bits and pieces, and the stakes are very high. And maybe I like what Russ, you were saying here, that maybe one of the aspirations we can have for a truly vibrant market-based system is that ultimately it can depoliticize things a little bit, and maybe that's a nice parting note and something to work towards and something to aspire to. And we have 10 seconds left, so
perfect.
Any last hurrahs? By all means.
Thank you.
Thank you very much. Bye-bye.
Thank you, Carl. Appreciate it.